Welcome back to Your Average Investor. Today we're going to look at Realty Income, stock ticker O, and determine if it's a good buy or not for our portfolio. We'll be analyzing some financials as well as dividend and technical analysis. Now, if you haven't already, please subscribe to the channel. It means a lot to help support this channel so we can grow and get more content like this out in your way. That being said, let's take a look. If you're not familiar with Realty Income, stock ticker is simply O. They are a REIT, or a real estate investment trust, which means they buy a bunch of real estate and then they collect rent on the real estate, and then they have to pay out 90% of that in dividends. So you'll notice here that since IPO, they've grown relatively well. Then around 2008, 2009, the great financial crisis, they crashed down to about $14 per share. And since then have grown to where they hit a peak of about $85 per share right before COVID. Massive dip down to about 38, came back up to 75, and now we're hovering anywhere between $50 and $54 per share depending on the day. Now what's incredible about this is you can see here this entire time, barring maybe a couple of small instances, they were paying consistent quarterly dividends. In fact, let's bring up their dividend history right now. We're going to bring this on over and search O dividend history. And let's look at this. So here's the dividend history for Realty Income. Current yield is sitting over 5.5%, so not bad. I mean, if you're looking at getting something with yield right now, another option, of course, is going into like a 1-year certificate of deposit, which is going to yield you around 5% depending on where you buy. So you could get a guaranteed 5% with that. The nice thing that I like about things like Realty Income over CDs, though, is that there is appreciation on the underlying asset, potential appreciation on the underlying asset, in addition to the yield that you get. Of course, that comes with its own risk because there's potential stock loss as well if, for example, something happened and Realty Income were to drop 10% or 20% in share price. Then collecting dividends would take you a few years just to get back to break even. So that being said, let's take a look here. It looks like their dividends have consistently grown. So we're back out 2006 now, 11 cents, 12 cents, 13, 14, 15, 18, 19, 20, 1, 2, 3. We're at 24, we're at 25. We're almost at 26 cents per share per quarter. These guys pay Realty Income pays a monthly dividend, not a quarterly, a monthly dividend. So you are getting almost 26 cents per share on a monthly basis. That's another really nice thing, especially if you're reinvesting dividends. You can reinvest on a monthly basis instead of on a quarterly basis. So keep that in mind here. 27 cents per share. It's been continually going up. Looks pretty dang good. Now, if that's the case, then it begs the question, why has Realty Income kind of struggled to recover back to this peak of $70, $80 per share? The primary reason is interest rates. Interest rates have gone up. It's a talk of the town every time there's an FOMC or other meeting is what's Federal Reserve, what's Jerome Powell going to do with interest rates. The reason that's so important is because these guys buy real estate and they're not buying it with cash. They're buying it on a loan, and that loan is going to have an interest rate that is benchmarked to the Federal Reserve rate. So if the Fed raises rates, then these guys, when they get a loan for a new property that they're going to rent out, that loan is going to come with a higher interest rate, meaning their monthly payment on that loan is higher, and they either have to charge higher rents to make the same amount of profit, or charge the same amount of rent but get less profit per deal that they go in on. And then, of course, if they have fixed rates, it's not a big deal. So if they were, back in 2019, 2020, locking in fixed deals at 2.5%, 3%, that's great. But if they weren't, if they were variable loans that they were, if they were locking in variable loans, then those loans are going to now be more expensive than what they were just a few years ago. So if they had variable loans, that's one reason. And then the other is, of course, for new deals, it's going to be more expensive. But not necessarily a bad thing, because that all that means is they've got to hunt for better deals or increase their rent prices on their properties. Now, the other reason that some people are scared of Realty Income is because of the commercial, I don't know, what would you call it, CRE crisis, commercial real estate crisis. So commercial real estate, people talk about this all the time. I don't know where I land on it personally. I think ultimately what I decide is I'm not informed enough to make a true decision here. But basically, since COVID, people have struggled getting renters back in office spaces. That's the TLDR, right? If you've got a big old office space, then everyone went remote during COVID, and now you're trying to get people coming back to office and renting your space again. Well, they don't want to do it, or not as much. So there's a gap in the market there. And same with like if you own like a strip mall and you're renting out spots in the strip mall, right? It's like curious. That should say crisis. If you're renting out a strip mall and you can't fill all the booths in this, all the places in the strip mall, same thing. You've got empty places where you should be collecting rent when you can't. So let's look at we're gonna look at Realty Income, investor relations. This is important, right? We want to know what are we investing in if we buy Realty Income. This is really important if you're looking to buy a REIT, is to find out what their portfolio actually is. So here we have Realty Income's portfolio. They've got 15,450 commercial properties under long-term net lease agreements. Portfolio occupancy is 98.6%. That's really encouraging, right? If you have over 15,000 properties and your occupancy rate is 98%, almost 99%, well, that's phenomenal. And then you look at the diversification in that, right? They've got 1,500 different clients in 89 different industries. Geographically, look at this. This is nice, right? So they've got some stuff in Europe. You can hover. This is a nice map. Look at this. I can see they've got 11% of their properties in the UK, a little bit in France, a little bit in Spain, a little bit in Portugal, Germany, Italy, one in Ireland. They've got some up in Alaska, and then I can look in the United States and say, okay, what do they have in the United States, right? Okay, 5% Florida, 10% Texas, 5% California. Let's see if we can get it. Oh, there it is. 2.8% in New York. 0.2%, 0.2%. Oh, look at that. 89 properties in Washington, so small that it doesn't register as a percent. You can go through and say, okay, maybe you think that Florida is not a good place to be investing because you don't like Ron DeSantis, or maybe you think California is not a good place to be investing in real estate because you don't like how it's being run by Governor Newsom. Well, good thing is only 5% of their properties are in Florida and only 5% are in California, and they've got just a really good mix all through the United States and a little bit in Europe, and it looks like actually here they've got some properties in Puerto Rico and some properties in Hawaii as well. So that's good, right? They've got a nice mix of properties across all the different states and in a lot of different areas. So next we want to know, do they do anything other than commercial real estate? Do they do, for example, single-family housing or maybe apartment complexes or things like that? So let's see. We had, let's look at this overview here. Okay, top 10 industries. Grocery stores, 10%. That's nice. Grocery stores aren't going anywhere right now. Convenience store, very similar to grocery store, 9.5%. Dollar stores, I'm not a big fan of dollar stores. That seems kind of weird to me, but you know what? What the heck, 6% there. Home improvement, great, 6% there. That's going to be like Home Depot, Lowe's, Ace, hardware, things like that. Drug stores. Restaurants, this one, if you're thinking, oh man, restaurants are going away, or that's a big deal because of like COVID times, maybe we get another COVID-like shutdown and it hampers restaurants. Well, it's only 5% of their portfolio, not a big deal. Automotive service, that's not going anywhere. Health and fitness, not going anywhere. Oh, here's more restaurants. They've got quick service restaurants and casual dining. General merchandise, 3%. So that's a pretty good diversification. Look at their clients here. They've got Dollar General, Walgreens, Dollar Tree, 7-Eleven, Wynn Resorts, FedEx, Lifetime Fitness, BJ's, B&Q, CVS, LA Fitness, Red Lobster, Walmart. Walmart leases properties from them. Pretty incredible. Top areas. We already looked at this. UK, Texas, Florida, California, Illinois, Iowa, Massachusetts. And that's not bad. Property type. Industrial, gaming, other, and retail. That's fine. And we already looked at the geographies. Okay, so looks like they've got a pretty good mix here. I don't think they're going to have an issue if I'm thinking about what they're doing, right? They don't have, they might have office space somewhere, but it's not in their top 10 industries. So that means it's less than 3% of their portfolio if they do have office space, which I'm sure they do have some. So not a bad look, honestly. I kind of like. Actually, full disclosure, I'm invested in this personally. I own a decent bit of Realty Income. I like their monthly dividends, and I own it at about, I think my average is like $52 or $53 a share, something like that. So I've been bouncing from up to not over and over. From a technical perspective, what are we really looking at here? Do we really have anything to go off of technically? There's a nice base that's formed right here and a little bit of a lower base here. So we've got this base around 50 and this new base around 52. And it looks like maybe there's going to be coming a little pullback, right? So this last time it based, it came all the way up to $60 a share before retreating back down to this 51, 52 area. And now it's basing and moving on up. And I think, we could see something like this where it comes right back up to $60 a share before bouncing around again. I wouldn't be buying this to trade. I would be buying this only if I'm interested in investing long term. I don't think you have a good setup here. I mean, maybe you could say you've got let's add some drawings to our chart here, right? Maybe you could say you've got a little bit of a formation here of some lower lows, right? Here's a low and higher lows. Here's a higher low. But if you're looking at it from more of a long-term perspective, look at this. We've got all of these, right? Here's maybe our trend line right there. Lower high, lower high, lower high, possibly a lower high right here. Maybe what we do is we see this squeeze in the 53 area for a little bit and we just get a mega concentration, which would suggest price has to move somewhere eventually. So either it breaks up into the 60s again or breaks back down into the 50s or maybe even the mid 40s. If it came down in the mid 40s again, I'd be a massive buyer. Of course, this is pending like crazy news, right? If they're talking about bankrupting and so the stock drops to $5 a share or $1 a share, I'm not going to be buying. But pending any stupid news, I'm just looking at if this has another major dip, I'm buying a lot. And as far as what it's looking like right now, you're getting a 5.5% dividend if you purchase at current prices. That's not bad. That gives you a little bit of downside protection if you're planning on holding for long term. Again, if you're trying to do a trade on this, I don't really like it for trading. Maybe there's going to be a breakout again to 60. That doesn't really seem like it. Like it seems like there's going to be better setups out there for you. So long term, I like it. I love the monthly dividends. Monthly dividends are great, right? Like let's just say you bought 100 shares of this. Let me bring my calculator over. So let's say you bought 100 shares at 54.79 per share. So you're spending $5,500 here, and then you're going to be getting times 27. You're going to be getting $27 a month for that, right? And it's like, oh my gosh, that's nothing. I'm spending $5,000, getting $27 a month. This is $27 a month for doing nothing. And what that means is every 2 months you can just buy another share of Realty Income. Or if you're on Robinhood or something with partial shares, you can just buy a half share every single month. And then, of course, by the end of a year, you've added 6 more shares to your portfolio, pending where the stock price is, but around 6 more shares to your portfolio. And you continue to do that year over year, and your dividends are growing. I think it looks pretty good. Options, I actually have sold covered calls on this before. It's one of the things I love about REITs is that generally they're pretty dang slow movers. Like they're not going to have crazy fluctuations up or crazy fluctuations down. Besides, if there's some drastic change in the Federal Reserve interest rates. So if interest rates are going to remain the same, which it sounds like they are for quite some time based on what the Federal Reserve has been signaling, then probably what we'll see is we'll just see some slow growth or maybe even literally just bouncing up and down between like $55, $65 a share. So this is really interesting, right? Like let's say I'm looking at an option about a month and a half out. So I could say I buy today at whatever it is, $55 a share. And I want to sell a covered call on it. And so I just sell this covered call $5.55. So what's going to happen here is I'm going to make $110 in premium. I'm going to get a dividend payment of $27 for holding 100 shares through that period. Even if I'm talking about if I get exercised. So I'll make about $22 in appreciation, $110 here. So we'll go 22 plus 110 plus 27 would be, so I'd make $159 on, what was it, about a 5,500 investment, right? So 159 divided by 54.79 is what it was. So I'm making like 2.9% in a month. It's nothing to write home about, nothing big. But again, likely what happens is this expires worthless. Or if the price does move up, what I do is I buy this one back and roll it out a little bit further and say maybe I buy this one back and then sell the 57.5 for 3 or 4 months out, and then continue to collect that dividend until either I cannot roll it anymore and I get exercised, or the price moves back down and the contract expires worthless. So I think it's a pretty good dividend stock. I like it. Do your own research, make your own decisions. This isn't financial advice for you specifically, but I think they're well diversified. They pay a nice dividend, and I love the monthly. I love having it paid monthly. It's so nice seeing that come into my stock account every single month and be able to do something with that cash to buy more stock or something like that. So thanks again for watching. If you enjoyed, please subscribe. If you didn't enjoy, subscribe anyway because it doesn't cost you anything. We'll catch you next time.